Brad Williams, Frugal Finance, bonds. You understand bond risk? I'll explain. Like other investments, when you invest in bonds and bond funds, you face the risk that you might lose money. Here are some common risk factors to be aware of with respect to bonds and bond funds. Interest rate risk or market risk. This is the risk that changes in interest rates in the U.S. or other world markets may reduce or increase the market value of a bond you hold. Interest rate risk increases the longer you hold a bond. Opportunity risk. This is the risk that a better opportunity will come around that you may be unable to act upon. The longer the term of your bond, the greater the chance that a more attractive investment opportunity will become available, or that any number of other factors may occur that negatively impact your investment. This also is referred to as holding period risk. Duration risk. This risk is associated with the sensitivity of a bond's price to a 1% change in interest rate. Duration, which is stated in years, signals how much the price of your bond investment is likely to fluctuate when there's an up or down movement in interest rates. The higher duration number, the more sensitive your bond investment will be to changes in interest rates. Call risk. This is the risk that a bond may be redeemed by an issuer when interest rates are falling, similar to when a homeowner seeks to refinance a mortgage. This is a risk for bonds that include a call provision or are callable. Investors can avoid call risk by purchasing non-callable bonds. Call risk also leads to a reinvestment risk. Refunding risk. Some bonds, often including those issued by industrial and utility companies, contain sinking fund provisions which require a bonds issuer to retire a certain number of bonds periodically. This can be accomplished in a variety of ways, including through purchases in the secondary market or forced purchases directly from bondholders at a predetermined price. That latter model is referred to as refunding risk. Refunding risk also leads to reinvestment risk. Reinvestment risk. This is the risk that no available investments will be able to provide a similar return to a bond that has been called or mandatorily refunded. Credit risk or default risk. This is the risk that a bond issuer will fail to make interest payments or to pay back your principal when your bond matures, other than U.S. Treasury securities, which are generally deemed to be free of default risk. Most bonds face some degree of credit risk, which is often indicated by a bond's credit rating. You can research and compare bond credit ratings through nationally recognized statistical rating organizations. Inflation risk. This is the risk that the yield on a bond will not keep pace with purchasing power. For instance, if you buy a 5-year bond in which you can realize a coupon rate of 5%, but the rate of inflation is 8%, the purchasing power of your bond interest has declined. All bonds, but those that adjust for inflation, such as TIPS, expose you to some degree of inflation risk. Liquidity risk. This is the risk that you won't be easily able to find a buyer for a bond you need to sell. A sign of liquidity or lack of it is the general level of trading activity. A bond that's traded frequently is considered more liquid than one which only shows trading activity intermittently. You can check corporate bond trading activity and thus liquidity with FINRA's Market Data Center. Event risk. This is the risk that an event such as merger, acquisition, leveraged buyout, major corporate restructuring, or other event might result in changes in a company's financial health and prospects, which might trigger a change in a bond's rating. Event risk is extremely hard to anticipate and might have a dramatic and negative impact on bonds. Sovereign risk. A country's unique set of risk is known collectively as sovereign risk. A nation's unique political, cultural, environmental, and economic characteristics are all facets of sovereign risk. Default risk is real in emerging markets where the sovereign risk, such as political instability, could result in the country defaulting on its debts. Currency risk. This is the risk that a change in the exchange rate between the currency in which your bond is issued, euros, say, and the US dollar can increase or decrease your investment return. The impact of currency risk can be dramatic. It can turn gain in local currency into a loss in US dollars, or it can change a loss in local currency into a gain in US dollars. This document will be listed below. If you have any questions relating to bond risk, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.